learning outcomes. After watching this video, you will be able to explain the difference between ordinary annuity and annuity due. Calculate the present value of an ordinary annuity. Ordinary annuities. In this video, we show how to calculate the present and future values of identical periodic cash flows, which are called annuities. An annuity is a stream of identical cash flows made or received, separated by equal intervals of time. A $10 a month payment for a year is an example of an annuity. However, a $10 monthly payment that occasionally skips a month, or a stream of payments that alternates between $10 and $20 is not an annuity. Both the amount and the time interval between cash flows must be the same for it to be called an annuity. There are two types of annuities: ordinary annuity and annuity due. An ordinary annuity is one where the cash flows occur at the end of each time period. An annuity due is one where the cash flows occur at the start of each time period. The figure that you see compares a 4-year $1,000 a year ordinary annuity to a 4-year $1,000 a year annuity due. As you can see, in the ordinary annuity, the payments occur at years 1, 2, 3, and 4. Whereas in the annuity due, the payments occur at years 0, 1, 2, and 3. Let us compute the future value after 4 years of the 4-year $1,000 a year ordinary annuity. Let's say that the interest rate is 10% a year. The payment at the end of the first year has to be moved from year 1 to year 4. So its future value is 1,000 times 1 plus 0.1, the whole thing raised to the power of 3, which equals $1,331. The payment at the end of the second year has to be moved forward from year 2 to year 4. So its future value is 1,000 times 1 plus 0.1, the whole thing raised to the power of 2, which equals $1,210. The payment at the end of the third year has to be moved from year 3 to year 4. So its future value is 1,000 times 1 plus 0.1, which equals $1,100. The payment at the end of the fourth year is already at the end of the fourth year. So its future value is simply $1,000. So the future value of the 4-year ordinary annuity is 1,331 plus 1,210 plus 1,100 plus 1,000, which equals $4,641. To get a more general form, let us denote the future value of an ordinary annuity as FVA, the periodic payment by PMT, and the interest rate as R. Then we have FVA sub 4 equals PMT times 1 plus R raised to the power of 3 plus PMT times 1 plus R raised to the power of 2 plus PMT times 1 plus R raised to the power of 1 plus PMT. This can be extended to an end payment ordinary annuity, in which case we have FVA sub n, which equals PMT times 1 plus R raised to the power of n minus 1 plus PMT times 1 plus R raised to the power of n minus 2, so on, plus PMT. This can then further be simplified to FVA sub n is equal to PMT times, within square brackets, 1 plus R, the whole thing raised to the power of n, minus 1, the whole thing divided by R. What if we want to calculate the present value of an ordinary annuity? We have calculated the future value of the ordinary annuity. Essentially, we converted a stream of cash flows into a single lump sum number. We can now move the single lump sum from the future to the present by discounting it back n years. Denoting the present value today of an ordinary annuity as PVA sub 0, we have PVA sub 0 equals FVA sub n divided by 1 plus R raised to the power of n. But we already have a formula for FVA sub n, which we can now plug in for. So now PVA sub 0 is equal to PMT divided by R, times within square brackets 1 minus 1 over 1 plus r raised to the power of n. Let's look at an example of how you would use the formulas. Say you have your heart set on buying this beautiful condo. Its current price is $500,000, all of which you will borrow from the bank. The bank will charge you an interest rate of 10% per year, and the loan will be for 30 years. Assuming that you make annual payments at the end of each year, how much will you repay the bank each year? To start off, I hope you recognize that this is an ordinary annuity, as the payments are made at the end of each year. Since you borrow $500,000 today, PVA sub 0 is equal to 500,000. It is a 30-year loan with annual payments, so there will be 30 payments in this ordinary annuity. So N is 30. R is given to be 10%. Now we are interested in calculating the annual payment, that is PMT. We will use the formula PVA sub 0 is equal to PMT divided by R times 1 minus 1 over 1 plus R, the whole thing raised to the power of n. Plugging in all the known values, we have 500,000 equals PMT divided by 0.1 times within square brackets 1 minus 1 over 1 plus 0.1 raised to the power of 30. We need to solve for PMT, which comes out to be $53,039.62. That is, you will pay $53,039.62 every year for 30 years to pay off the loan. In the next video, we will talk about the concept of compounding frequency and effective annual rates and how it impacts present and future value calculation.